to talk about the big annual investor conference of BofA-ML. The head of research, Jyotivardhan Jaipuria, joins us. Jyoti, good morning and thank you for joining us. Jyoti, the timing of the conference, some would argue, is slightly tricky. It is coming ahead of elections and it is coming after a big rout in emerging markets.
Yes, it's always good if you can, do something before the event, because post-event, like investors want to position themselves ahead. Because in the last two elections, what we've seen is that markets had big swings on the day of the election. So in some sense, you were either in the market or you were not in the market. So you want to do that ahead. It's always good if, markets have corrected a bit when investors come in, because that's the way they can make money.
Yeah, but doesn't that risk being, a bit overconfident, if I may use the word, of the big election event where there is enough political uncertainty? The market is pretty much getting into the event expecting a mandate.
Yes, elections are always a risk, and it's also a risk because it's something which, most of the investing community is not good at. They're not political analysts, really, they're stock market analysts. But it also provides an opportunity because, the typical thought process would be, once the elections are out of the way, whichever government comes in, they have a mandate for a few years. So, in the first year of your mandate, it's easier for you to really undertake reforms because you don't have to think of election considerations. In the last year, it always gets tougher to undertake reforms. So, that's the thinking for most investors, that we probably will get some sort of reform acceleration after the elections, irrespective of the government. The stronger the government, the easier it will be to have reforms coming through.
Jyoti, in 2014, most of the emerging markets, they've got hit hard, be it Argentina, Korea, China or Turkey. But India clearly seems to be outperforming emerging markets as a basket. Do you think that is the big story we should focus on? That irrespective of what is happening in the emerging market world now, given how macros have moved for India, there is serious scope for India to outperform further?
It's basically two things. So if you look at absolute sense, India is also down year to date because all emerging markets are down. And for a lot of investors, emerging market is not exactly the place to be in just now. But within the emerging market space, India is standing out because of two reasons. One is, our currency has been very stable. So unlike 6 months ago where, India was at the forefront of the currency crisis, this time India has had a very rock solid currency which is, boosting investor confidence. Second is, for a lot of people, India has been in the last 6 months into this whole election atmosphere. Once May is out of the way and we have a new government, then reforms will start accelerating. And third is, interest rates, because the general thinking is inflation starting to come down in India. It's one of the very few countries in the world where interest rates are what they were at the peak of 2008. And so the thinking is, okay, so can we get interest rates coming off substantially in India, and that could help turn around the economy.
What is the expectation on growth? Because, there's one thing that the risk on inflation is receding, the macro risks are improving. The finance minister spoke at length about how the deficit numbers will look a lot better next year. And then the other debate is about, how much of all this will translate into growth picking up, because the key theme there is investment.
Yeah, so, my view is growth is probably closer to the bottom. But we're not going to see a real acceleration over the next 6-9 months. So growth is probably going to be a 2015 story, not a 2014 story. But for the stock market, if we go back into history, if there is a big event change, so it could be in the form of a change in government or, a government which is now getting easier into the reform mode because elections are out of the way. Or second is we have a situation where interest rates start to come down. In either of these situations, markets typically go ahead much faster anticipating growth. They don't wait for the growth to come in. So I don't think we're going to see acceleration in growth in 2014. It's a calendar 2015 story. But for the markets, do we start seeing signs that growth is going to pick up 6 months down the line?
Jyoti, so based on your research, give me a name, idea, group or a sector or a theme where you're confident of a 14-15% return in next 1 year.
If we look at our things, we are playing it in two segments really. One is some things which have done well all this while and which we think will continue to do well. So this is like the software sector and the pharmaceutical sector. So growth in these sectors will be intact, earnings growth will be quite strong, and that really will drive stock price performance. The other segment we are playing is the domestic rate sensitives. So this is a segment which is underowned. This is a segment which has underperformed the market, and this is where we see the change coming, because interest rates are going to get cut, because the reform acceleration will be there, which will mean that people will start anticipating a pickup in the economy. So the sectors we are playing here are sectors like the autos, which of course got a bit of boost again from the budget also now. So autos is one thing we have been massively overweight on in the last 6 months. The other sector we have actually turned bullish on over the last month is like the energy sector, because I think subsidies are probably going to get eased off over the next 12 months, and the market will start pricing this into the stock prices.
Sorry, what about the cap goods sector? Because last October there was much talk about how orders are going to come in, the order book is going to pick up, again in anticipation of growth coming into the economy. The last couple of sessions, given some stops from the finance minister, you're looking at some interest building for these stocks, large caps as well as mid caps. Is this a decisive move or another trading bounce?
Okay, so it's the reason we are not as bullish on the cap goods sector, but it is definitely a sector which could give much bigger returns than a lot of these, is more dependent on the reform acceleration. We need the government to come in and quite strongly accelerate reforms in the area of infrastructure spend before we see like capital goods starting to do well. So that is something which you are playing as a higher risk, higher return, that you are really betting on the election outcome getting positive. If that works out, then probably this sector could give a much bigger return than some of these other sectors I spoke about. But if some of these events don't work out, then they could continue to lag a bit. So that's the reason Nikunj asked where you are more confident. So our confidence is in some of these other sectors. The capital goods is something which we play as a high risk, high return type of sector.
Jyoti, but some would argue that IT is a crowded trade. Low-hanging fruits already have been plucked. The IT index was up by more than 50-60% in 2013. This year also the IT index has added another 5-6%. So do you think all the good news, all the talk about visibility, all the good price, all the predictability, isn't that in the price?
See, to some extent you're right, that basically we've seen a sharp re-rating of the sector. Going forward, I don't think re-rating is really going to drive the stock prices. It's just going to be sheer earnings growth, and probably at some point the sector may give returns which are lower than earnings growth, so we may see a bit of re-rating coming in the sector. At the same time, the earnings growth will be strong because their principal market US is doing well, and orders will keep coming in from there. So it's a sector where you have visibility on growth today at a time where growth is a scarce commodity in the whole emerging market space.
Jyoti, what are the kind of sound bites you are picking from your clients? Do you think they are still happy to own defensives, which is pharma and IT, or now the valuation argument for economy related stocks, cyclicals, is also looking quite appealing? So at high levels they are now looking at switching out of defensives and revisiting cyclicals. Has that switch started yet?
Okay, so there's been a very marginal switch over the last probably few months, and two reasons which are driving this switch is, one is the election and whether the post-election scenario leads to an acceleration of reforms, and second is the possibility of interest rate cut. So I think for investors, like at our conference also, we've seen a lot of interest coming through in the domestic economy names, because everyone knows the story about the software and the pharma and all the defensive names. People believe that okay, there's nothing really which is going to change over there, those companies will continue to do well. But what people are trying to get a sense of is, are things changing for the domestic economy plays, for the rate sensitives, and how substantial and quick can be the change?
I was just reading a note by BofA-ML on the launch of the VIX futures on February 26. You think that's really a blessing that the market was waiting for, given that has been so volatile of late?
Yeah, it's something which they have done, and generally globally people look at the VIX to try and figure out a short-term direction of the market. In India, the history of the VIX is still very limited and the volumes have not been great because so far there were no futures. So I think, once it starts getting more actively traded, then, in India also you could really start looking at the VIX to give some sense of where the short-term market is headed.
Jyoti, you like autos, and so far that call really has not made a lot of money. But now that after the excise duty cut, companies have slashed the product prices or car prices and two-wheeler prices, do you think demand will come back?
Yeah, like our view was, it was not just the excise duty cut, because that's something which we are obviously not building in. The view was that, once interest rates start to get cut, if you look at sensitivity, then typically these stocks start to do well more or less simultaneously with the interest rate cut, and the demand starts picking up with a lag of 6 to 9 months. So possibly, in early part of 2015, we think demand will be much stronger than what it is now. But you can't wait till the demand picks up to buy the stocks really, because the stocks typically anticipate this change. Second is, if you see election history, typically autos does very well 3 months and 6 months before election and continues to do well post-election. So it is one of the most consistent plays in an election year actually.
Jyoti, what's the view on PSU banks? I take the argument on asset quality concerns, the NPA is rising there, and quarter on quarter that situation doesn't seem to be improving. There were some signs this quarter around that things might be changing, especially for a bank like Punjab National Bank. But going forward, if the premise is that there's going to be growth coming in, then a lot of these PSU banks, purely on the basis of value, I would imagine, should look attractive.
Yeah, so we've been cautious on them for a long time. We still actually continue to be cautious, because two things. One is, yes, if when growth picks up, these things will do very well. But the issue is then if we get so certain of growth, then you're talking of capital goods earlier. So there are lots of capital goods stocks, there are a lot of infrastructure stocks, probably, those may offer better value in terms of stock price performance. The other thing we have to remember for the PSU banks is that, there's going to be a lot of capital requirement in the PSU banks over the next few years. So I estimate is the whole PSU banks as a basket would need around $30 billion of equity infusion from now to 2017, which is like over the next 3 to 4 years. So that, could start getting a bit of problem in terms of stock price performance.
No, but on that very point, Jyoti, while the finance minister stated that he set aside about 11,500 crores for PSU banks, he's also in his press conference indicated that he wants PSU banks to raise their own capital. Given that independence that they are getting in raising capital, and if that's followed up by what the next government also does, doesn't it become a very favorable environment for these banks to capitalize themselves through private issuances?
Yeah, effectively what happens is, if you end up raising capital to the extent of, let's say, 50% of your current market cap, then it involves a bit of dilution, and typically that sort of dilution, the stock prices tend to, not do well just because of the sheer supply of paper coming through. Second is, I don't think, governments are going to dilute their stake below the 50% in any of these.
The problem is that most of the banks are currently trading below book. So every time you are raising capital, when the stock prices are trading below their book, you are actually destroying shareholder value. And if you are a minority shareholder, the book value in fact will take a huge knock, because book value dilution will happen and money is not coming at the right price. Jyoti, let's talk about metals. Is there a tactical trade there? Because for the moment it appears that the problems from China clearly have taken a back seat.
Yeah, there could be a tactical trade, but it's one of the sectors which we've been avoiding for like over 2 years now, and we are not really playing it very strongly, simply because our call is that demand structurally from China is going to be much weaker than what we've seen over the last few years. So these are, more tactical things than really, structural things.
You've outlined your structural calls, which is IT, pharma and select autos. But what about your tactical call? What is a good tactical trade, let's say from here to the election, where you are reasonably confident of making a 10-12% return?
Yes, it's actually, these same sectors which we spoke about, because, what you have to go into election with a mix, because you election outcomes could go anywhere, so that's why what you're trying to do is have a balanced portfolio which has some defensives and it has some, aggressive names which will do well if the election go the right way and the markets like the election results. So that's why you're having a mix and getting into election with a real, mixed portfolio.
Jyoti, at the conference, if a client walks up to you and if he's ready, and if he has a query which is that, look, I have a 3-year time frame, I'm ready to digest a 15% volatility, I'm ready for a 10% downtick, but I want absolute return ideas. I want my portfolio to go up by about 25 to 30% in the next 3 years. How would you allocate capital for that client?
Yeah, so basically our 3-4 overweight sectors would essentially be the energy sector, the auto sector, and pharma and software. So basically these 4 would be the overweight sectors with a bit of allocation to the banks, especially the private sector banks.
What about oil and marketing companies, given all the talk about fuel deregulation there?
Yeah, so that's the energy sector, the oil and marketing companies.
You like OMC stocks, Jyoti? Did I hear you right? For someone who's extremely conscious about earnings, visibility, oil marketing stocks for the longest time, they have not made money for any shareholder. They are cheap, they're trading well below the replacement value, but where is the earning visibility?
It's basically a call on the fact that post-elections we will see subsidies getting eliminated. And, once that happens, then people look at this in a totally different light. Because if you see today the earnings, there's a lot of subsidy knock which they are taking. If you remove the subsidy knock, then, your earnings will be totally different from what they are.
Is your election trade buying to oil marketing stocks?
Yeah.
What about non-IT but yet exporters? Some manufacturing names, auto ancillary. Do you think that could be a strong theme? Because if I map what a Motherson Sumi has done, how Bharat Forge has moved, these stocks have done reasonably well.
Yeah, so we like the auto ancillaries actually, but most of them are mid cap, so it's not really a big cap sector. So we are very fond of some of the auto ancillary names, and we've been playing them for the last 3-4 years.